it's interesting that we've got the banks reporting. We've got finance reporting, starting to report this week. And if you look at the ETFs on my watch list, look what all three of these ETFs, what do they have in common? They're all in the financial area. You got FAS, you've got XLF, you got FAZ, okay? What do they all have in common looking at the data? Well, what they have in common looking at the data are this. They are all 49-day 49-day patterns. That means looking at the last 10 years of data, we've seen 49-day trades, all right? What kind of returns are we looking for? Well, those are kind of all over the board. FAS is at 9.89%. XLF is at 3.72% average return. FAZ, bearish average return, 11.79%. They all have 10 of the last 10 years moved in the same pattern, right? They all have end dates that are in the middle of September. They all have power meters that are positive, which basically means these trends just keep getting better and better. What are they? All right, let's talk about what they are. They are all financial. But when you dial them down and you look at what they are, XLF is the Financial Select Sector Spider Fund, all right? These are insurance companies, bank companies, capital firms, leading financial institutions within the S&P 500. That's XLF. When you look at the Fs, the FAS and the FAZ, well, they're exactly the same, only they're not. FAS is a 3x leverage ETF that's tied to the Russell 1000. Basically means if the financial index moves up 1%, FAS is designed to go up 3%. And FAZ, well, that's the complete opposite. FAZ goes up when the market when financials go down. FAZ goes down when financials go up. And like FAS, FAZ is a 3x. All right, it's a 3x leveraged ETF. FAZ is just inverse. It just moves the opposite of the Russell 1000 Financials Index. All right, so there's our three financials that we're looking at here for the week. Let's dial down on one of them. And the one I want to dial down on is XLF, right? The State Street Financial Services ETF. So if you look at what I'm looking at right now, this is a pattern starting today, going to mid-September, over the last 10 years. If we started mid-July and we went to mid-September, over the last 10 years, 10 of the last 10 years, these financial stocks have gone up in value. This particular ETF, it went up 2.52% in 2016, okay? Couple big notables. In 2020, it was up nearly 8%. In 2024, it was up over 9%. Last year, it did just over 4% return when you take a look at today going forward. Now, again, I have to say this is not financial advice, and there's no guarantee this is going to happen again this year, but I'm a pattern trader. I'm not a day trader. I'm not a meme trader. I'm a rules-based pattern trader, and this is one of the patterns that I like to look for. So if I were looking to buy XLF today, what would it cost me? And what are my alternatives? Well, if I buy XLF today, I'm looking at paying a roughly let's call it $55 a share. So 100 shares are going to cost me $5,500. What am I looking at? Well, what's interesting is this stock. I know there's a lot of stuff on the screen here, but if you take a look at the chart, stock was trading above 55. That was at the beginning of the year. In April, it pulled back into the high 40s. Look where it's at right now, right back to its yearly highs. All right, there's some pent-up demand here based on what happens with earnings for the financial sector. Could blow this out, and a lot of folks that are short this. A lot of hedge funds that are short XLF. Maybe they're short because of interest rates. Maybe they're short because of the economy, right? Because perhaps, if you look at home sales, new home sales, existing home sales, and current interest rates, homes are on the market a little longer than they are. Therefore, guess what? Mortgages are not in, they're not being created as much as they used to. These are what short traders are looking at. If they're wrong, they're going to buy back their shorts, and that's going to fuel potentially a higher price. We see XLF seasonally strong this time of the year, based on what we've seen in the past 10 years. The other chart that I want to show you on here, all right, the other line, this line right here is the options payout line. It's called implied volatility. I call it the option payout line. And it means that I can see what option prices generally are when I look at near money options. And I can see back at the beginning of the year, they were at levels that they're at right now. They're down near their lows for the year. In April, they were much more expensive. So I could buy the stock, $5,500 for 100 shares. Let's see what the options could cost us. So I'm actually going to go to Robinhood for this information. It's going to pop on over, and I'm going to look at Robinhood. And here's XLF. Here are the options that expire in September. Right, so September, XLF has 67 days to expiration for the September 18th options. And if I were to scroll down and look at the, let's call it the at the monies. The at the monies are going to be in that area of about 55. Here's 55.84 current real-time price. So the 56 calls are $1.70. Right, 55 calls are $2.31. So what does this mean? All right, if I buy this call option for $2.31, it's going to cost me not $5,500 to buy the stock, but $231 if I could get that price. Okay, $231 to do what? Now I now have the right with this contract to buy XLF at 55, but I'm going to pay $2.30, now $2.33. I'm taking the price of stock plus what I pay for the option. That gives me my break even by expiration. Now I have until September 18th for the stock to be above $2.33 above 55. So we're talking $57.33. Okay. So that's one way to get this much lower. We're now in a position where we're only paying what? 2%? I mean, it's a small number. This used to be twice as expensive, folks, when the payout chart was on the high side. So these options are very cheap. If we want to make it cheaper, then we could go in and we could build a spread. So I already know that we're fairly cheap here, but what we got to do is we got to look at this and say, well, okay, this is roughly 5%. Well, here's the problem. The problem is when you go back and you look at the information that we looked at, when I went in and I went to my money counter and I went to grab XLF and look at it, I noticed when I looked at XLF that I'm getting an average during this time of about 3.72%. Let's just round that up to 4%, just so we can all, we don't need a calculator to figure this out. So what does that mean? That means that when I'm looking at the stock and I'm looking at 55, 1% of $55 is 55 cents. So let's say 4% of that. We need this. This is telling us that between now and September 18th, that XLF should be up about $2 more than it is. If I'm going to pay $2.32 for something that's only going up $2, I'm not going to make money, even if I'm right. So I've got to go in and figure out a way, how can I make money at $57 for a target? Well, I need to be less than $2. I need to pay less than $2 for something where I can buy it at 55. That's where I go in and start looking at spreads. So I'm going to build a spread with everyone right now. There are several different ways of building spreads. The one I'm interested in looking at is the call debit spread. And with Robinhood, the call debit spread is fairly easy to build. What we're going to do is we're going to put down a couple things. And that is, number one, I got to know when my expiration date is. The expiration date is September. So here's the September 18th options, right, with 67 days to expiration. And then the other thing I might want to do is look at the strike prices. Let's say we look at something that's 5 points wide. What does that mean? That means that, what I'm buying, all right, and what I'm selling are 5 points apart. And I'm going to try to grab something, and I might be too high. Maybe, in fact, maybe I might want to go 2 points apart. Let's buy at the 55 level and let's sell at the 57 level. And that's where the stock price, again, that's where my target is. So if I buy 55 and sell 57, here we go. I can do that for $1.14. So what does that, in the end, what does that tell me? It tells me that if I'm looking for $2, if I'm looking for $2 move up, I can spend $114 to make potentially $2, but no more than $2. Okay. That is not a double. That's not a 100% return, but it is something close to 90%. Right. So there you go. So, when you look at this, and it lowers the cost, it lowers the break even. It also lowers the bar to profit potential, and your return on investment at 57 would be quite a bit higher than simply buying that stock itself. All right, simply buying the stock itself. So when I put it all together, we could buy the shares. Okay, that's one thing we could do. We could definitely buy the shares. The other thing we could do is we could buy calls on XLF, but I would say go deeper in the money so you actually have a chance of making something and not having all that time value erode for the couple of points that you see XLF potentially moving higher. And then the final thing, and this is, I've said this before, I did a video on this last week, why I like spreads as a position trader more than call options. And it's because I can put myself together with lower cost. I can put myself together with lower risk. I can put myself together with a better break even.